Hi, this is Zak Mir, editor of Spreadbet Magazine, with a look at some favourite oil and gas plays. Favourite probably with inverted commas in some cases, but looking at Xcite Energy at the moment in the wake of the partnership with Statoil and Royal Dutch Shell. I would have thought this is much more of a favourite than it was even a few days ago. We had the higher low in April above 60 pence, which sort of flagged the possibility of a recovery here. That's always a sort of the minimum requirement in terms of charting or technical analysis rules. And obviously, since the move higher, we've seen a massive snap of the RSI resistance line from January towards 35 to the 35 level as well. As far as the price action is at the moment, Tuesday's end of day close at 82 pence, back above the former March support at 80 pence, was the big buy signal there. And obviously, we also broke the 50-day moving average at 77 pence. So sort of double momentum there for the shares. As far as how much higher they may stretch, I'm looking towards the top of the falling trend channel from 2012 at 105 pence as the best case scenario in the near term. That would obviously see the shares rather overcooked, given that the RSI is already well above 70. So 105, the upside. Stop loss towards 85, maybe the 82 pence would be the sort of the technical end of day close stop loss on the long argument for Xcite Energy. Moving on to another recovery situation, not quite as dramatic so far as Xcite Energy, but still impressive nonetheless. We had the gap down for Bowleven through the 50 pence level in November. Since then, the shares have been sort of delivering an extended base, mostly support coming in at or just below 30 pence, with a higher low towards the end of April at 30 pence itself. So that was flagging the recovery. What helps now is that we've got a triple golden cross between the 10, 20 and 50-day moving averages. That is a rare configuration, a rare bullish configuration. And we also have an extended November RSI uptrend line as well to back the buy argument. The view at the moment really is, while there's no end of day close back below the 50-day moving average at 33 pence, we'd be looking for the top of the October price channel towards 50 pence, and the gap from November. The 200-day moving average at 45 should come in as the target area for the shares as well. So looking better on Bowleven, but still waiting for maybe the big breakthrough in terms of breaking above 37, 38 pence to get the move going. More difficult situation here at Gulf Keystone. Here, obviously, we've had the unfilled gap to the downside, massive head and shoulders formation, which triggered the decline from 160 towards 80, so basically halving the share price. Decent basing, I suppose, in some ways, given that we've had a higher April support above 80 in the second half of the month. That, as we've seen from Xcite Energy, did help drive the shares higher eventually, and at Bowleven too. So it could be that Gulf Keystone is setting itself up for a rally, but probably at this stage you'd want to see at least an end of day close back above the 50-day moving average at 111 pence at the moment, and also the RSI back above 50. It's only 47 at the moment, to really give you confidence that a sustained rally could be on its way. This is especially the case after the two failures for the shares towards 105 pence in recent days. Another Gulf stock, Gulfsands Petroleum. Here we've seen a massive recovery here. Shares were unloved and unwanted around the 30 pence level, but they did bounce off a July support line going through that zone, and then gapped up through the 20-day moving average around the 32 pence area just at the beginning of March. There was an extended bull flag, which was a consolidation, mid-move consolidation feature above the 50-day moving average as well. So we had a pretty good signal there that there was going to be a new leg to the upside. That's come now with the break of the 200-day moving average at 52 pence. And although we've come up a long way, I would still actually argue that the shares could hit the top of the July triangle, the broadening triangle, as high as 80 pence on any new leg to the upside. Such a leg could probably come in while we have no end of day close back below the 200-day moving average, as I said, at 52 pence. So risking 5 pence to possibly make 20 to 25 pence over the next 1 to 2 months. Finishing off with Rockhopper, and here you can see really a similar broadening triangle formation, but not quite as good a performance in the near term as we've seen at Gulfsands. Maybe that's only to be expected given how fantastic the rally there has been. But at the moment, what we're looking for really is a break back above the £1 level, say the 10-day moving average, 20-day moving average, just in that zone. If we can do that quite quickly, then one would expect a rally towards August, post-August, former post-August support between 110 and 120 pence over the next few weeks. At this stage, really only back below 90 pence would really kill the bull argument properly. So a bit of a cushion there as far as the bulls are concerned, but you want to see another show of strength after the initial May failure that we've seen. That's it from me. If you want more on oil stocks, you can check out my top 5 oil plays on Spreadbet Magazine. Thanks a lot.